Hey friends, welcome back to the channel. My name is Catherine, and here I talk about DeFi, economics, and all things Web3. And if you like this content, I would really appreciate if you liked, subscribed, and leave a comment below. When getting into DeFi, you might have heard the term slippage, but you're not exactly sure what it means. It may seem like a small technicality, but if you do not pay attention to it, it can end up costing you a lot of money. And I'm going to show you a transaction today that cost $2 million in slippage that I would want to pay, but I'll show you how it happens, why it happens, and the different protocols that you can use to get the least slippage possible. Now, let me explain slippage in the form of stock trading. Let's say that we wanted to buy some Facebook stock, Meta stock, and the price is $320. So we can buy some shares at the price of $320, but we cannot buy all the shares for $320 or even a lot of shares. So depending on how many we want to buy, the only ones we can buy at that price are the ones that are available. And once those have been bought, you will run through the order book. If you have a big order, you will run through the order book and the price will go up as you buy more shares because it's a supply and demand thing. So if you are buying a lot of shares, the price will go up as more people sell into a higher price. And slippage is the difference between the expected price of a trade and the executed price of that same trade. Now, on small orders in a highly liquid market, you're going to be totally fine and the slippage is going to be very low. However, if you place a large order and the market is illiquid, you could be looking at a lot of slippage. And I'm going to show you an example of that in the form of Olympus DAO, which just had a whale dump 13 million of the token in one sale, and it completely tanked the price. And I'm going to show you why. All right, so let's look at this DAO chart. So you'll see here when the whale dumped 13 million of ohm, this is basically a red wall of selling. So he started selling, the price was 161. By the time he was done, it dropped to like 125. And then what happened, you can see here a bunch of red, a lot of people that had leveraged their ohm, and when it dropped in price, they were liquidated, which cascaded the price even more. So if we look at the transaction, you can see here that they sold 82,526 ohm, which should have been equal to 13.26 million. However, when they did the swap, and by that I mean when they were selling, they were hitting a ton of liquidity issues, which causes 2 million in slippage. So the amount of money they actually got out at the end was 11.37 million. So they paid about 2 million in slippage because of the price just cascading as they were selling, which happens in illiquid markets. But Olympus DAO has a lot of liquidity, so it was interesting that the price dropped so suddenly, but I guess it's just from one huge sale. And you can see here that the sushi pool has $139 million of liquidity in it. So that is the total amount of money that could be taken out of that pool. So that is the Olympus DAO. And if you look at the Ethereum transaction, this is the actual Texan. And you can see here that if he sold right now, because the price is so much lower, he would have only gotten 9,153,000 instead of the 13 million that he sold for. And when you look at Texans like this, you can often see, okay, what is the price currently? So this is the price right now, but the actual transaction was 13.26 million, which is right here, but you have to screenshot it at the time or it updates the price to the current price of that token, which, as you see, has dropped a ton since that sale. So that's what happens with slippage and why it's so important to make sure that if you're trying to sell something, that you're selling into a lot of liquidity. When liquidity in a market is low, it's going to be very difficult to buy and sell, especially a large volume into it, because the liquidity isn't there to support it. And so you're going to have a high slippage rate. It's kind of like in 2008 in Florida. Everyone had one house or 5 houses, and you try selling those houses for the same price you bought for them. That is some real life slippage, my friend. Now, when you're making a trade, you can set the slippage tolerance that you're happy with. So sometimes the trade won't go through. Again, if you're an illiquid market and there's not a lot of liquidity and they want a 20% I've seen in a sort of shitcoin market, which you're trying to buy or sell into. You might have to set the slippage high, but if you're, trading coins like DAI, ETH, or any of the blue chips, it's going to be like maybe 1-2% maximum for a reasonably sized order. Now, I'm going to show you a couple of examples of trades with stable coins. Now, the thing about stablecoins is the last thing you want to do is to exchange one stablecoin for another and have a high slippage rate. So if I said, okay, I'm going to give you $1 and you're going to give me 92 cents back, that's a bad deal because it's a stablecoin. For common pairs that people trade all the time, there's not going to be a lot of slippage. So like DAI ETH is a very common pool and there's not going to be much slippage because there's such deep liquidity. You want to go to something like Curve Finance, which has almost 23 billion in deposits, which means such deep liquidity that you will get the best rate possible when you're swapping your stable. So for example, like the worst deal in the world will be, oh, I'm going to give you $1 and you're going to give me 92 cents because in some exchanges with enough volume, you're actually losing money with that slippage. And if you're swapping into a stable coin, that just makes no sense at all. So let me show you an example of this in action and how huge a volume that Curve can handle with such minimal fees. So let's take a look at what a stablecoin swap looks like on Curve. So let's say we want to swap 20 million into DAI coin. So if we take away the amount of DAI coin that we're getting after we switch out this 20 million in USDC, you can see that the exchange rate, including the trading fees, is 6,705. So swapping 20 million with only, 6,700 slippage is insane. It's such a low slippage amount. And you can see here that the exchange rate, including the fees, is 0.9997. And you really need this sort of liquidity in order to do these stablecoin swaps, because the last thing you want to do is, give someone $1 and they give you 95 cents back. Now let's look at something like Sushi. So Sushi is another DEX, which is on all the different chains, but does not have nearly the liquidity that Curve does. So if we do the same thing, USDC to DAI, this is 20 million. And you can see here that same swap of 20 million would have a 47.6% slippage rate that's shown here. So you're actually only going to get 10.5 million back, which, I mean, you would never do this, but that's just showing you how important it is to have such deep liquidity. Now, if you want to, Uniswap is much better for stablecoins. However, the fees are higher. So again, if you're swapping stablecoins, I would highly recommend Curve. And if you're just swapping tokens, you can go up here and change the slippage tolerance so that you're not, if you have a tolerance like, above 2-3%, that can add up, especially if you're doing a lot of volume. So pay attention to the slippage, and you can get front run. If a bot sees your transaction and sees that your slippage is high, they can front run you and cost you some money. All right, that's what slippage is. Again, pay attention to it. Don't get front run. Don't lose money in transactions because you just forget to set that thing. But if you are going into an altcoin market, you will need to set that slippage higher when there's not a lot of liquidity. All right, if you like this content, please like, subscribe, and leave a comment below of what other questions you have about DeFi that I can answer.